Hi, everyone. This is Jason Burak of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest, but I've been following his work on Twitter. He just puts out really excellent research, very impressive, a lot of good charts and graphs that I just don't see anywhere else, especially for free to people who follow him on Twitter. He is a portfolio manager at a hedge fund, Crescott Capital. Tavi Costa, thank you for joining me today.
Hey, thanks for having me, and thanks for the introduction. That was very nice. Look forward to talking to you as well.
Yeah, I mean, you've had a lot of great calls now since April and May. I think you nailed almost the timing of gold and silver almost perfectly, this big rally that we've had.
It was, in hindsight, seems easy, but it was definitely not easy at the time. I don't think there was, it was very, there was a lot of confirming macro data, but anyways, you're always going to miss something, and hopefully you'll get things right. It's a probability game always, and we did get one part of our thesis wrong, which is the bear market in the U.S., which I think we're trying to really trying to validate that, and hopefully I think that's where part of the opportunity lies ahead here for the following months.
That's very interesting. And if you were wrong about your call for the rally in gold and silver prices, I think some of these primary gold and silver miners would have went bankrupt. But before we talk about the gold and silver rally, let's get your views on the global macro situation that allowed you to make some of these really good calls, your 30,000-foot view of the global macro situation. So it seems to me, Tavi, that over the last 6 months, there's been an acceleration of bad news, bad data, and the global economy is weakening, whether you look at the export data from Germany, Japan, Taiwan, South Korea. Is that what you see as well?
Absolutely. I think outside of the U.S., there has been a lot of confirming data of how, through PMI numbers or export numbers and even the currency moves, that it seems very clear that there is some slowdown outside of the U.S. Now we're starting to see also some confirming data in the U.S. of things that are starting to look a little weaker than they used to maybe a year ago or so. But in terms of the macro ideas in general that we have, I think it's easier to just think about our highest conviction themes today, which one of them is really at the center of a lot of the imbalances we see worldwide is China, as we think it's a historic credit bubble that is now in the process of bursting. And we obviously think that will be globally contagious. And I think the currency is in a big risk of a much larger devaluation that we saw now in this month, last month. And I think that's going to have a lot of implications globally. The second one is the U.S. being just being at the peak of a business cycle here, which we think that a lot of companies have already had their profit growth already peaked, and now that we're seeing some very big divergences in the market overall, with not a lot of companies leading here in the market, and sectors are starting to fall apart, which is I think it's a major part of the thesis, and along with their macro models showing how overdue for a recession we are in the U.S. And the third one is what you already mentioned, which is the precious metals, as we think it's going to be the real way of first, it's extremely undervalued as a safe haven itself, and I think there's a way of really protecting capital here if there is a downturn in economic expansion and economic cycle as we're predicting.
I see four large, I call them economic landmines. I think the U.S. corporate bond market has me very worried, especially that chart about now how there's over $1 trillion in negative yielding debt. That's just going to send the signal to these large corporations that they can continue to borrow for cheap, leverage their balance sheets, misallocate capital, do more bad leverage buyout deals, and potentially there's going to be more General Electrics down the line. I know the debt-to-equity ratios for a lot of these large corporations are well above 1, and it seems a lot of people don't care as long as these large companies have earnings and they're paying a dividend for now. And then you mentioned China. I've been accused of being a China basher, but like you, all I do is just follow the information, and China's own data from the National Bureau of Statistics in China shows that higher food prices have gone up a lot in the last 12 months. Their manufacturing data, their industrial output was really bad from June to July. I think it dropped 24% according to their own government economic data in only a month's time. So there's just a lot of red flags with China along with the currency. Then today they just lowered the reserve ratio again, which is, that's a dovish move, and they already, I agree with you, like you said, they have a credit bubble. I agree. They have an enormous credit bubble. I agree with most of what Kyle Bass says. The European banks have me very worried, and then also emerging markets now with the dollar rally. Today when we're speaking on Friday, September 6, 2019, the trade-weighted dollar index, Tavi, is at an all-time high at over 131.
Mm-hmm. Beautifully said. And the funny thing is that U.S. markets are, 3 percentage points away from all-time highs. I mean, it's a very strange world that we're in. In terms of of negative yielding debt, that's another, I guess, confirming or just supporting point for owning precious metals. In my view, I think that's all a link to that thesis. But the U.S., you're starting to see a few things like you see the BLS preliminary down revision of I think was last month or so of 500,000 non-farm payrolls, and then that was a big deal. The last time we had something like that was in 2008, and the ISM numbers that came out early this week, with the new orders, employment, the price paid, all those are trending lower as well. Now we're starting to see still if you look at the confidence, the consumer confidence on the Conference Board Index, which has also a great track record of predicting recessions as a contrarian indicator, as consumer tends to have a very high confidence at the peak of cycles, and it's still a pretty high level, but the Michigan Sentiment Index is starting to fall apart. It had the largest monthly drop in 7 years, and the yields continue to go lower. The yield curve inversions, which I think it's a key part of what's happening today in the world. The percentage of inversions that we calculate, which is just literally looking at all possible spreads in the yield curve in the U.S., it got to a level of 75% of the yield curve today in the U.S. was inverted. But, we see this problem all over the world. Like Canada, 90% of its yield curve is inverted. Japan has never been this inverted. It's close to 67 to 70% inverted. Hong Kong is another one with a political crisis on top of that. 80% of its yield curve was inverted a few weeks ago, and now it's close to 70%. UK is the same problem. I mean, you name it. It's very clear to us that the credit markets are moving ahead of the equity market here, as it tends to do usually. So I think we're approaching the very end of an expansion cycle, and I never seen U.S. stocks look so toppy here.
So the stock market, if you go and look at a 2 or 3 year chart, the stock market hasn't done very much now. The general stock market indexes since January of 2018, I think they're close to maybe a little bit below what they were in January of 2018. Do you see in terms of capital inflows and capital outflows, it seems to me I see a lot of these stories that a lot of net capital outflows out of emerging markets, especially emerging market stocks. Do you see a lot of net capital inflows coming into the U.S., into the treasury market? Is that what you see in terms of capital inflows and capital outflows?
Absolutely, and I think it has a lot to do with the fact that we have about 17 economies with 30-year yields lower than the Fed funds rate, which is, I think there's a lot of takeaways from that chart, but one of them is definitely the fact that it means a global yield curve inversion, as the spread between those two yields, 30-year versus the Fed funds rate, tends to reach a negative, spread every time you're at the peak of a cycle, and happen in the housing bubble and again in a tech bubble. So that definitely causes the flows towards treasuries in the U.S. and some people now are, as I think that if you really research what what the bullish thesis is. I'm sure some people think there's going to be a trade deal, but I think that's kind of minor. I think that the bigger amount of the bulls there are really kind of relying on this flow of since yields and bonds are so low, it kind of makes sense owning equities, and since kind of the U.S. is the only game in town for a lot of the bulls, that seems to be reasonable to own U.S. stocks. And again, that's a flow game. And if you go back in history and see when yields are also low back across the globe versus things like yields in the U.S. and the short-term yields in the U.S., like it happened in 07 and so, and with 30-year yields dropping below the Fed funds rate, like I mentioned. I mean, that didn't cause the equity market to move a lot higher. I think it's more of a flow towards risk off assets versus risk on assets. I think there's a big chance of if we do have another start having a sell-off here in the U.S., people are they have a short-term memory. We're going to start remembering what happened in the fourth quarter of 2018. It's very easy to see people starting selling off their investments and causing a more disorderly sell-off, which I think it's very possible to see here until the year end. So I think there's a big chance that we might see the retest of December lows and go even lower than that by the end of the year or so. And I think that's going to have other implications of especially in the precious metal side and the way the Fed might actually behave according to that, and just global growth in general, because the rest of the world used to depend a lot on China and still does. But now, in terms of financial markets, has been kind of holding the pack here. It has been the U.S. And if that turns lower, I think that would change the macro setup very quickly.
Yeah, it seems that in terms of a historical reference, you talked about 2007. This reminds me a lot of 1927 to 1929, except back then a lot of the capital inflows that came into the U.S. went into the U.S. stock market, but it seems that a lot of the capital inflows now are coming into the U.S. Treasury market as, like you said, a risk-off trade, because people, I guess, on a relative basis, they're still getting a positive yield in U.S. Treasuries compared to other countries, and they still view, I may disagree with them with this, but professional money managers view the U.S. as relatively safer compared to other people. Compared to other countries. So as a professional money manager, your job, you can't be in all cash, right? It's not really allowed. I mean, some professional money managers, if they're running a family office, but hedge fund managers and other professional money managers, they can't go to all cash normally with their clients. So do you find that the professional money managers have to make bets then on what's going to, with probabilities, like you said earlier in the interview, on what's going to collapse first?
Correct. So we've had the beauty of having more than one theme is that you obviously, as I said, you supposedly you're going to get one of your teams right in a big way, and definitely got the precious metal side right, and the devaluation of the Yuan so far this year has been a good profit attribution for the performance. In terms of allocating money on cash and staying on cash, we're doing that a little bit on our large cap strategy, because it's hard to protect that strategy as we're supposed to be long stocks, and we have a few mining stocks obviously, but we still wanted to hold some cash itself. But for the global macro fund and long short fund, which gives us more flexibility to really invest on things like shorting stocks and things like that. We've been shorting stocks. We've been shorting the most overvalued stocks that we can find, especially things like the software stocks more recently, which I've done a few dive-ins in terms of those of the whole industry, and it's really interesting how today you have a lot of those companies trading at I think the median company in that industry is trading at 75 times free cash flow, which in our view you that's kind of insane. I mean, there's over 1,100 analysts' recommendations in the entire industry. Only 4% of them have a sell rating. So answering your question, yes, we're trying to take a proactive approach here and being short stocks, and we're shorting. We have models that help us to that guide us to figure out what are the most expensive companies out there, and that's really the best way to do it. And I think that I find it very difficult to, and I'm not saying on a daily basis, meaning of daily moves I don't really care, but I find it very difficult to see the equity markets moving higher, but the precious metals entire theme moving a lot lower and hurting us in a big way. In other words, I don't see if equity market's going to move higher, it's because of an extreme monetary policy coming from the Fed or globally, and I think that would be dilution of global fiat currencies, and that has to be positive for precious metals. I feel like precious metals is perhaps our best hedge against being short the equity market, which certainly hasn't felt that way in the last few days, as precious metals have done incredibly well at moments when equity markets start falling apart. But on the long term, it's really hard to see, and that therefore why I think that being long precious metals and short stocks for a less sophisticated type of investor is perhaps the best way to really protect your portfolio in the following months.
So you've been putting out charts on your Twitter for the last couple weeks now with stocks like Ulta Beauty and Netflix. Those were some of the top performing stocks since 2009 and 10, right? And those charts are breaking down. Now, one of the other top stocks like Lululemon, another top consumer stock that sells very expensive yoga pants to customers, they're a good business, they have high margins, they sell a lot of these products. That stock hasn't broken down. I would watch that one. If that one starts to break down, and that's been one of the leaders, then that's confirming that things are getting a lot worse. But some of the leaders of the stock market, though, are starting, the top performing stocks for years now are starting to break down, though, right?
Yeah, I mean, and Netflix was a big one for me. I think it was one of the FANG stocks, obviously, and breaking a 5-year support line is just and forming a death cross. I'm not a big technical guy, but I pay attention to that because it's a market darling. And in my view, when those leaders with very silly valuations start to fail, that's really when the business cycle is over. But if you looked at Netflix, for instance, it's trading at like over 100 times free cash flow estimate for 2022. I mean, it's really insane. Autodesk was another one that also broke down, and it trades at over like 600 times earnings, and so there's definitely a ton of those. And we had yesterday another important one that didn't get enough attention. Well, a lot of people talked about it, but I think the market didn't get enough attention of it. But was WeWork revaluing its IPO now, almost 50% lower. And I put out this article the other day of SoftBank lending $20 billion to its CEO and employees to invest in their own fund. Talk about levering up, and it's all it's all coming to sense now. It's a typical market top behavior, and very clearly we're probably getting close to an end here. And I still think that, and some the usual person that you meet here, at least in my space, is yes, I agree with you, but I wouldn't short stocks here. We're shorting stocks, and that's, I think this has been a part of our approach, and we're hoping to really profit from what we think it's one of the best opportunities to profit from a downward move here in the business cycle.
Do you think that the Federal Reserve will start to cut rates aggressively in the near future? And what about quantitative easing? Because I don't think the rate cuts, if they do them, if they do a 25 basis point rate cut, I don't think that will stop a correction in stocks. But if the Fed were to announce, say, a large quantitative easing program again and start rapidly expanding their balance sheet again, that would potentially hurt the bear thesis for the stock market, because then there would be a lot more liquidity coming in. The other thing, Tavi, is the U.S. Treasury has put out estimates for September and the rest of this year, and they're projecting that they're going to need to sell many hundreds of billions of dollars worth of Treasury. So do you think then that the Fed has to do QE to buy up those Treasuries, or do you think that there's demand for those Treasuries from other entities like insurance companies, pension funds, bond index funds, bond mutual funds, maybe for foreign investors?
Yeah, a lot of things to unpack. So the first one, in terms of the QE, personally, I don't think central banks can prevent business cycles from turning. And the best example of that is not just me saying it, is actually looking back in history in 06, 05, and all the way to 07. There was a lot of money printing happening already globally, not in the U.S. Prior to the housing bubble burst. And that never really helped the cycle to or extended the business cycle at the time. That actually was pretty much aligned with the market starting to fall apart. If I don't forget, it was somewhere close to $2 trillion or $3 trillion of money printing prior to the first QE in 08, and then after that was somewhere close to $4 to $5 trillion of total money printing at that time, including the PBOC and the ECB and the Fed. And this is I'm not even talking about the other QEs that happened, the third phase and the second phase or so. I'm just talking about throughout the downturn in the cycle. So I firmly believe that if companies and investors really start seeing that the economy is going south, I think the selling will really pressure the market to move a lot lower, regardless of QE. And like I said, I think that if let's say I'm wrong in this thesis, and there's going to be a lot more QE than we thought. And the great thing is that for gold investors today, there are a lot of them are very not really trusting this beginning of a move. A lot of them, because we had a lot of those initial moves in precious metals, and then they kind of faded away. I think this time it doesn't look like those other times in the last 7 years or so. It looks like the other ones that happened right before a market crash, and especially because now we have the benefit of looking back and seeing how central banks will probably behave if there is a crisis, and everyone now is expecting a QE. Back in 07, 05, people are not talking about that as much as we talked about today. So the policies are getting more and more aggressive, and I think that's going to become an issue. Now, in terms of the Treasury part, certainly I do see the QE coming. By the way, I agree with you. I think QE is probably coming. I'm not sure if it's to create demand for selling Treasuries. I don't know exactly if that's what it's going to be, but it could be. I can definitely see that. My problem with Treasury is not even that. Is I can definitely come up with a thesis here for why Treasuries or yields could move a lot higher as well. Then that's why, for me, it's difficult to bet on Treasuries in a big way. I much rather bet on gold and silver and miners, at least for now. I think just looking at pension funds and large allocators of capital, I think they've been under-allocating capital towards precious metals in a big way for the last decades or so, and that can be a positive change. Think about the mining industry as well. I mean, how many companies today are in S&P 500 are gold or silver mining stocks? How many? Just one. That's all. Just a possibility for positive change that could be very, very, could really benefit the entire space of precious metals. So I'm really positive on that whole industry, and I think it's going to be look very different in a few months.
To add to your point there about how large pools of capital and generalist professional money managers and other high net worth people don't agree that the gold price may go higher yet, they're not fully on board. There's been attempts for some primary gold miners to raise capital, $100 million or more. Last week, I think there was a deal where New Gold, it came out in the Toronto Globe and Mail. Well, the story came out last week. And New Gold, which has a lot of debt on their balance sheet, they tried to raise $150 million, and the syndication of investment bank wasn't able to sell $50 million of the equity immediately. So they were stuck with it, and it took them over 2 weeks to dump the shares to get rid of it themselves, although they didn't lose money on it, but it took them 2 weeks to break even. So that, to me, shows that there's still not a lot of interest from generalist investors in funding these gold miners yet that a lot of people still don't believe that gold and silver prices are going a lot higher?
Yeah, I mean, it's possible. At the same time, if you look back, I mean, gold really in my opinion, really started to bottom in 2015 was perhaps the day when it bottomed, and from there it's actually up about 50% since that day that it bottomed. And if you look at gold mining stocks and which bottomed about in early 2016, we haven't actually surpassed the 2016 highs in August of 2016, which is different from gold. Gold already surpassed that level, which shows that I think that there's really high demand for physical gold itself, and I think that this on the mining stocks is at the beginning. The first move is definitely a more speculative type of move, and then it has to kind of fade away a little bit in order for the speculative boom starts to become more of a real bull market, which is the second leg of the bull market that I think it's likely to happen here. I think we're going to go higher than the previous highs of 2016, especially given, just look at where we are in the business cycle here in the U.S. and how every economic indicator pretty much, or the major ones at least, are not showing organic growth, any improvement fundamentally in the economy. Everything is turning lower, in my opinion, and not my opinion, it's a fact. You can see so many of them, from manufacturing to exports to the current account, and so many. So if you just focus on that, I think that there's a really easy case here in my view of how gold and silver can move a lot higher, and I can't see that happening without mining stocks doing the same. And there is no doubt that mining stocks look terrible and balance sheets look terrible, and this is part of the beginning of a cycle. I think this is all it's unfortunately it's kind of allocating money to those ugly ones right now. It actually looks attractive to me. It's kind of like investing in those oil companies right after the oil crash into right at the early 2016 levels. So, it kind of reminds me of that. It was ugly. I mean, all those companies have negative free cash flow. They had a ton of debt. You're kind of relying on the assets part of it. Are the assets more valuable than if obviously they will be if the underlying security gold and precious metals move higher. So I think that's kind of the play. I'm very focused on the ones that have right reserves, really high reserves relative to where they're being priced in terms of enterprise value in general, including the debt, obviously. Then, and I think that's the approach that we're taking. And by no means, I don't know if I'm going to be right, but I think there's a really big, really high probability in my view that mining stocks, we're at the beginning of a bull market period here.
Yeah, in terms of risk reward, if you know what you're doing, you do your homework, and you buy companies when there's blood in the streets, and if you find the right companies with the right balance sheet that can survive the bear market, and then the bear market turns, you can do well. I'm a big fan of Sir John Templeton. One of his most famous quotes is, bull markets are built on pessimism, rise on skepticism. They continue to rise on optimism, and then they die on euphoria. And I think we're still in the pessimism and skepticism phase with gold and silver companies.
You nailed it. And I mean, we talk to people, we talk to investors and money managers in the space, and you can see that a lot of them are actually focusing, most of them focus because of the bear market here, especially mining stocks. Some of them down 80-70% from their 2011 levels. And I mean, a lot of them are actually focusing a lot on companies that are very profitable, that have really great balance sheet, and there's nothing wrong with that. But if I have more of a macro trade here, which I think is the case, that I think that precious metals are going to be moving higher. I do want to take some more asymmetric bets, and I think the asymmetric bets are definitely on the side of the smaller companies. And no, I'm not taking a large position on any of them. Who knows if those are not. It's really hard to get your arms around, as you know, on a lot of those assets and knowing if they are really what they say they are. And it's, and getting your arms around it, it takes a long time. So I think we're using a lot of models, and we're spending time talking to a lot of people and meeting with companies, and hopefully we'll pick the right ones. But I think we have the right approach. I think that regardless if the whole, if we're right about this macro trade, I think the entire space is going to move higher. The question is, which ones you want to bet bigger, and which ones are probably going to move higher. I think that the ones that have more leverage, obviously, are the ones that are going to move higher as long as there's nothing crazy going on. So I think that's really the focus for Crescat right now in terms of the mining space, not just the physical part of precious metals.
And what worries me the most, and it hasn't happened too much yet, is when some of these miners are going to start doing massive amounts of dilution. So people have to be careful for that. So just because the gold and silver prices are going up does not mean all the mine shares are going to go up evenly. Sometimes these companies are just waiting for the opportunity to go out and dilute the stock a lot. You got to be very, very careful about that. Now, I want to transition to the dollar. How big of a problem is a U.S. dollar rally if the trade-weighted dollar index, if the regular dollar index continues to rally, in your opinion?
Certainly a problem for places like China. There, seems like, at least in our view, seem to be selling forward USD swaps and having a net short, being net short the dollar probably will be an issue. By that, if that happens, obviously that would be terrible for the rest of the world. I think China would seriously get in a recession if that happens, because right now, China has been able to kind of it's kind of interesting, right? When you look at the move in the Yuan, for instance, look at just the correlation, the rolling correlation between USD CNY or CNH versus Treasuries yields, and it's actually it's never been so correlated, and it's interesting because there was before there was kind of a theme back in the days that if there is a devaluation of the currency, you would expect yields move a lot higher in the U.S. because China would be selling foreign reserves. So that hasn't happened yet. What happened was that there was a devaluation of the currency and there was no selling of foreign reserves. Why hasn't happened? I think that the reason why is because the reserves are encumbered, and they're able to use that as a collateral to then make bigger moves in the forward market. So that has been kind of our case for the last 2 to 3 years, and I think that that's been kind of proved right, at least this year so far, with yields actually moving lower, not higher, and that entire thesis was so far proven wrong. Because, you can't be naive. If they do sell $1 trillion of treasuries, that has to have an effect on yields. But the fact that they're not doing so is kind of interesting. I do believe strongly that the reserves are encumbered. And I, going back to your question, how big of a problem? It would be a huge problem, especially for emerging markets. Look at Brazil. That happened in 2015, 2014. That caused, I think it's interesting. Sure, maybe the political crisis that brewed in Brazil was kind of in line with some other macro factors that happened, but that causes a whole turmoil in the country. So I think that's possible to happen, especially in places like China. I think that would be really the end of the whole expansion in China, and that would be very problematic for the rest of the world. But we're also long the dollars, and especially against Asian currencies, against the Hong Kong dollar and against the Chinese yuan, and also long gold. I don't think there's being long the dollar and being long gold, they don't have to work against each other. It doesn't mean just because gold is priced in dollars that you can be long gold and then be long the dollar versus other currencies that you think are a lot worse than the dollar itself. And we do believe that the Hong Kong dollar, especially with what's happening, is very likely to depeg or has a high probability, especially when you look at the pricing and the implied vol of betting against those currencies is relatively cheap, and it makes a lot of sense to put those trades on, I guess. But I hope I answer your question. But I do think it's critical if the dollar moves higher, especially with this dollar squeeze and amount of what we're seeing, especially because of the interest differentials of 30-year yields versus the Fed funds rate, as I mentioned, causing flows towards dollar-denominated assets like treasuries, certainly causes the demand for the dollar as well, which I think is the third takeaway from that distortion.
There's a massive amount of dollar-denominated debt now. It's increased a lot since the 2008 financial crisis. A lot of these emerging markets, not just China, were betting on a weak dollar, and for the last few years that has not happened. The dollar did have a correction, I think, in 2017, but it's since started to rally very strongly, and I think a lot of that has to do with the dollar-denominated debt. Now, you're from Brazil. You talked about selling those forward dollar swaps. Brazil got in trouble betting on a weak dollar, using those derivatives to sell forward dollar swaps. Didn't Brazil's currency take a very, very big hit? And historically, emerging markets that have tried to put on these forward dollar swaps trades, they've gotten their currencies hurt really bad, right?
Absolutely. Brazil had a lot of issues. I mean, the biggest enemy of Brazil has always been inflation, and exchange of the currency exchange has definitely evolved for that implication. And it's actually very opposite from what a lot of people think, because of the current account of Brazil. Brazil sells a lot of commodities to places like China. China slows down. Brazil can't sell goods as with the same type of demand, especially when their currency, the Chinese currency, devalues. Their buying power goes lower, so it decreases the demand for Brazilian exports in general. And the problem with Brazil is that Brazil exports a lot of raw material and imports a lot of final products. So that causes, the devaluation of the real certainly has caused historically is a very high correlation with inflation. So that causes inflationary forces to move higher, and it tends to cause issues in the whole country. So in terms of the of selling forward swaps, that has been a problem of a lot of countries. Mexico during the tequila crisis was also an issue, and it seems to be a problem with every emerging market. I don't think this time will be different with China personally. But what I think it's even more interesting about the situation in places like emerging markets when they crash is to pay strong attention to things like gold. Gold in local currency terms is what tends to rise when those things blow up. And I think that's kind of the case in China, when at the beginning of the year a lot of people used to say that the China was pegging their currency with gold. I thought that was absolutely no sense. I was very vocal about that back in the days, and I still am about it, because I think that it makes no sense. When a country has a credit bubble, you can't just peg your currency with gold. I mean, if there's a problem with non-performing loans rising, which we think there is one in China, how is that not going to cause dilution, and then a problem with gold itself rising because of that dilution in the currency? I mean, I think that's kind of the situation today, and therefore why you're seeing this problem with gold prices in local currency terms in China rising, and also in places like Brazil and Argentina and Turkey. And look at gold prices denominated against those local currency terms, and they're all rising, and it's a very important development, and one way to profit from an emerging market bust.
Yeah, to add to your point there, I think emerging markets have a lot of headwinds. So it's like 4 or 5 really big ones. I did a live stream show, a video on this in the last couple of weeks, that not only do you have China slowing down, which is the top customer for commodities, you also have a bear market in energy, oil, and also base metals. So that hurts emerging markets. And then emerging markets have net capital outflows out of their stock markets, which historically for decades now has been a very big signal that emerging market currencies could come under pressure. And then on top of that, you have the dollar-denominated, and this might be the worst one of the bunch, you have the dollar-denominated debt, which these emerging markets have gambled on a weaker dollar, and then you have the dollar rally in the trade-weighted dollar index, which is just screaming higher. So I'm sure these emerging markets, their governments, their treasury departments, their central banks are on the phone to the Treasury Department here in the United States and also the Federal Reserve and the White House trying to get the U.S. to weaken the dollar. But, if they don't, this could end very, very badly for emerging markets.
Yeah, I mean, there's a lot of, I think there's, it certainly seems to be a conventional thought, and I think conventional thoughts could be right, and I actually, I'm on that camp on this one, of a currency war happening worldwide. I think it's happening, and it's probably going to get worse as economic growth gets worse, and central banks are forced into more aggressive policies and trying to depreciate their currencies, and I think that's only going to get the problem even worse. But it's interesting for me in Brazil. We're not betting against Brazil. We may have a position here and there every now and then, but it's really a very small, very marginal position relative to the portfolio. But I find it interesting that I hear a lot of investors in Brazil because I'm involved with just people in general there, and it's incredible how people are bull, and it's hard to find a bear in Brazil. Everybody is a bull, and it's. I think this is kind of I haven't seen that in history of Brazil. I mean, Brazilians have never been this optimistic about markets in general. And sure, maybe that has to do with a change in political power, but it's pretty interesting. I mean, it's Brazilians are betting heavily on stocks today, and yeah, Brazilian stocks will always look cheaper than the U.S. So that whole kind of a bullish thesis of emerging markets looking on valuations of U.S. equity markets versus Brazil, that's never going to work because Brazilian stocks are always going to be cheaper given the political and the economic risk is much higher than the U.S. And always going to look like that. But and I'm not saying the U.S. looks great. I'm just saying it makes sense, right? That to price it at lower multiples. That's all. But I've never seen so many bulls in Brazil.
That's interesting. So do you see a scenario, because of all the global macro problems that we've discussed, do you see a scenario where the Fed does cut rates 25 basis points at a time, maybe a couple of those over the next 6 to 12 months? They do that, and then they restart QE at some point where the dollar can still continue to rise relative to other currencies, or do you think the dollar at some point is going to top out once maybe QE restarts and it's going to start to correct?
At least for the following year, which I think is where I'm mostly focused on for investment reasons, I guess. I don't see this weakness in the dollar because of a really aggressive policy from the Fed that is not followed by other central banks outside of the U.S. I think other central banks are pretty much in line with the Fed, and if the Fed does what it seems like it's going to do, which is cut rates aggressively and maybe even back to zero and go back to QE, I think that's all going to be kind of followed by other central banks, perhaps ECB and the BOJ and the Bank of Canada and so forth, and the RBA.
Emerging markets are already doing it, right? The emerging markets
already.
Sorry to interrupt you. Yeah, we just got announcements.
You're absolutely right. Yeah, you're absolutely right. A lot of emerging markets are doing it. I mean, China did a massive one today. I actually want to research this, but it's kind of interesting how the Chinese currency actually went the other way after, because I've done a research before looking at the required reserve ratio of major banks in China, and if you looked at versus the Chinese currency, it actually follows the same line for years. I mean, for decades, really. In other words, as they lower their required reserve ratio, that tends to also cause the currency to devalue. It makes sense, right? They're easing, and you would expect that to have a negative effect on the currency. But the point being, it's kind of interesting how the Chinese currency did appreciate today on those news, and maybe because of maybe market is just pricing in of more strength in the Chinese economy going forward, which I completely disagree with that. But hey, I think one important point that a lot of people are paying attention to, especially in Asia, is and I really want to dig into this in the following days, is the Hong Kong banks. Look at Hong Kong banks, every single one. Name one of them that is not breaking down from major support lines, and I'm talking about some of them like Bank of Asia or East Asia or some others, CITIC, even HSBC and so forth. I mean, they all look terrible. They look like Deutsche Bank, a few years ago. It looks really ugly, and it actually reminds me of 08, prior to 08, 06 or so, when U.S. banks begin to fall apart here in the U.S. slowly, and right before the overall market start to fall apart. So it's an important similarity here of looking back in history of other ways that bubbles end up unfolding or bursting, and I think it's playing out similarly in Hong Kong. I do feel that that's a kind of a signal that the market is telling there's something bigger about to happen here in Hong Kong, especially when you look at HSI index, still relatively high when compared to what the banks are doing.
There's about I don't know if you follow this, but there's about 4 or 5 pretty crazy with some circumstantial evidence swirling around HSBC Bank. Kyle Bass has been tweeting about this over the last couple months, some of the stuff, and he even mentioned this on a Yahoo Finance interview, but last month, but the journalists who were interviewing him just totally ignored what he said.
It's all interesting. I mean, Kyle Bass has been definitely on the front of a lot of those, of figuring out a lot of those issues in Asia, especially. We've done a lot of work too, and I admire a lot of his work. I think it's pretty incredible. I think that there's a lot of it's really difficult. It's really challenging to bet against the Hong Kong securities because of the laws on shorting those securities. But you can have some issues with that. But I do think that the currency side is interesting. There's some ETFs in the U.S. that look kind of interesting that you can get some exposure to the financial system in Hong Kong. But overall, I mean, it's just looking at the size of the banking system, and then when you compare that, relative to the how much, let's say, just what's one example is the amount of provisions those banks have been doing for the last few years. It's sometimes, depending on the bank you look at, they're now provisioning for loan losses even lower than they used to do prior to the Asian crisis. So it's quite interesting. And aside from the banking side of Hong Kong, the other part that kind of caught my attention recently has been the housing market in China and Hong Kong. The property developers and the home builders in those in China especially are now, I mean, they're pretty significant size of the economy. It's about like over $1 trillion of enterprise value. And looking at those companies, they only generate like less than $10 billion of free cash flow for the last 12 months. So those companies have been accumulating a ton of debt, losing a lot of money for years. And I think it's starting to, the bomb is ticking a lot faster more recently, especially when you look at Evergrande. Evergrande, I think I posted a chart of Evergrande breaking down recently, and it looks very interesting. I mean, they just reported their profits actually collapsed in the last report for about like over 50% on a year-over-year basis. And the stock is down like 45% in like 5 months. Then they have close to 50% of the debt is going to mature this year, according to Bloomberg. So it's like, everything kind of makes sense in terms of like there's something brewing in China. And then you look at the currency, just had its largest monthly move in 25 years. It was even worse than that 2015 devaluation that we had in August of 2015. So I think there's a further dilution here in the currency dilution here in the next months or so in China. I think that's going to be an important macro development for the following months or so.
Yeah, I agree. There's a lot of red flags in the Chinese banking system. Since Baoshan Bank was taken over in May, it seems, the bailouts have gotten larger. They've gotten more creative rather than a normal bailout where one larger bank buys the smaller bank. It's become the second bailout was Bank of Zhengzhou, and then that was kind of a Bear Stearns engineered one where one ICBC had to buy a large stake, and then two just distressed debt managers bought stakes. And still, a couple days ago, the Bank of Zhengzhou couldn't pay their dollar bond. So this was supposed to have been taken care of. China was supposed to have calmed down the interbank lending market, and then they go and they let all that work that they put in the last 3 months or so, they risked that with allowing the Bank of Xinjiang to not pay their dollar bonds. And then the third large bailout, the Chinese Sovereign Wealth Fund had to step in with Hang Seng Bank. So these are big red flags. I think there's a lot more problems coming down the pipe, more than just a currency devaluation.
Yeah, you're right. And the question is, who is the smarty pants who created this cocoa bonds? But anyways, if you look at those banks that you just mentioned, I was looking at them and just aggregating amount of assets that they hold. Still, it's close to like $420 billion of assets. I mean, we're talking about a few percentage points of China's GDP. I mean, it's definitely very, very significant, that could derail a lot of other issues in the country. And those are all bailouts and already, and nothing has really happened yet. And very few people know this, but the median stock price in China, for instance, in the fourth quarter of 2018 was down somewhere close to 40 percentage points already. So, tell me one place in history that had a situation like that in their equity market, that they were not, facing a recession or some significant slowdown in the economy. So China certainly is having some issues. You look at the current account problem. I think the current account problem is a massive problem. I mean, I had a chart of that one time, and I haven't posted that chart in a while, but just looking at the change in current account in China or versus a lot of countries versus the change of currency value of a lot of countries. And you can see very clearly China has been one of the only countries in the world that was able to appreciate their currency since the global financial crisis and still shrink their current accounts significantly. That tends to coincide with currency devaluations. Argentina is probably the best example of that, of a current account that probably shrink close to like 10% or so, and their currency went away. I mean, it was 90 or so percent of depreciation in the currency value. So, I think that the other place is Hong Kong as well, by the way, that lost significant amount of current account over the years, and Saudi Arabia too, and all those places. I mean, this is just one factor. There's other factors, obviously. That's why China, Hong Kong looks appealing given the size of the banking system and the problems with non-performing loans and what we see as growth is slowing and probably going negative and so forth. And that kind of goes along with the consequential damage should have issues in the currency, and therefore this is just one factor. But it's quite interesting how shrinking current account is a big problem. It's definitely a very important problem that goes along with the housing issue and non-performing loans issue and so forth.
If you add up the assets of those three Chinese banks that have been bailed out so far, it totals about the size of Wachovia in the U.S. during the 2008 financial crisis, before Wells Fargo had to buy Wachovia. Wachovia had around $500 billion in assets, or I think their market cap, Wachovia's market cap was $500 billion. I don't know about their exact amount of assets, but their market cap was $500 billion. So do you subscribe then to do you subscribe then also to Kyle Bass's thesis that there is a dollar shortage in China as well? Because you talked about the current account deficit, Kyle Bass has talked about that. It seems to me that China's rationing dollars, that they still have some dollars, and you said earlier in the interview that their reserves were encumbered. So they didn't have the ability, they didn't have a lot of liquid dollar reserves either in treasuries or dollars. So do you think then they're trying to prioritize and figure out where the best way to spend their dollars, because they just don't have enough dollars right now, probably because of the trade war and also because China's economy is running a current account deficit?
Yeah, I think they're using the treasuries as a collateral to make a bigger move in the forward market. I mean, just look at what we're doing, betting against the Chinese currency. A hedge fund, of less than $100 million is able to get, a few, maybe 200-300, whatever percentages higher than of delta exposure to or nominal exposure to relative to NAV to the Chinese currency. I mean, think about what you can do with $1 trillion or $1.2 trillion of collateral assets to on the forward market. It's probably a pretty big damage, and probably what's been happening for the last few years. And it's hard to calculate what it is, but I think it's probably a pretty pretty safe bet that there's something like that actually happening with the PBOC. There are some signs of that. It's as I said, it's hard to measure, but it certainly seems like there was an incident with us back in 20. We've been short the Chinese currency since 2014, just for the record. And we know it was a great trade in 2015, and it was really cheap to do that back in the days. Nowadays, it's getting a lot more expensive. So we've seen kind of like the evolution of this process of shorting the Chinese currency. And back in the days, when we wanted to short the Chinese currency, there was not a single person shorting it, and it was kind of interesting. The reason why I'm telling you this is because we asked the broker at the time, we're like, who's taking the other side of this trade? Who's buying Chinese yuan? And at the time, the guy was like, well, it's the PBOC, and then we're like, well, how is that possible? It's a pretty small number that we're shorting here. But now I can definitely see that's very possible because there was not a lot of liquidity on the other side of the trade. And I can definitely see that the PBOC is probably taking the other side of a lot of hedge funds betting against the yuan, and it's becoming harder and harder to do that because the implied vol goes higher. But I still think it's still an interesting trade, especially in days like today when it moves against you. That the implied volatility also goes lower and moves like today in terms of pricing in a higher move on the upside of USDCNH. And I think there's a high probability that the yuan could devalue 20-30%. It's very easy to see a scenario like that, and if that happens, that could be a big change, and not just macro-wise, but in the country. What does that mean for Chinese GDP and in dollar terms and all that? I mean, it's going to be a big change in a lot of things. And but anyways, I think China is getting close here to a bigger move in the currency side, but.
That's very interesting because, I mean, the exchange rate, the RMB has, since the beginning of August, the RMB has been devalued a lot. It seems that the PBOC is losing control of their ability to prevent big moves in the currency. I mean, it seems that they do want some devaluation, but I don't think they have as much control over their exchange rate now as people think because they don't have as much dollars to fight this. Do you think that the PBOC, because of their derivatives position on these forward dollar swaps, do you think that they're getting big margin calls? I read an article from Jeffrey Snyder on August 7th talking about when the RMB broke 7, and he is hypothesizing, his thesis is that every 3 months now, China just gets enormous margin calls to try to defend this currency position.
Look, I don't have any insights on that. I wouldn't be surprised, but I have not found any data besides just kind of contemplating if that's actually the case. But I think it's possible. I mean, there's definitely I can definitely see a scenario of that happening. I just find it weird that that the correlation between yields moving higher and USDCNY moving higher as well. Sorry, yields moving lower and the Chinese currency moving lower is that correlation never really happened in history, which a lot of people were kind of calling for that. The Chinese currency would never devalue because of the size of their foreign reserves, and it has been devaluing, and the foreign reserves haven't been sold. I do believe that for me is more telling than anything else. Is the fact that like any other central bank would have probably sold a little bit of their foreign reserves to defend their currency, and China is being forced to not do so because first investors will see it and they'll see it as a weakness, a sign, right? As a weak sign when a country starts selling their foreign reserves to defend their peg or defend against a speculative attack, which is the case here. So I think the amount of believers that the Chinese central bank or the PBOC doesn't have full control over the currency are starting to increase. And just go back 3 years ago or 4 years ago when we were doing this. I mean, it's there was not a single person that thought that way, and it's definitely shifting the other way now. And looking more and more interesting, but the devaluation itself hasn't really happened yet, which it makes you think, right, of the level of intervention of the central bank should have been much more extreme in the last years. Because of that, kind of increase of speculative attack across hedge funds in general, betting against the yuan. So I think it's definitely possible that China is getting margin calls and so forth.
So I've kept you for almost an hour. I'm very appreciative of your time. My listeners are going to love this interview, your insights. So thank you very much for that. Last question before I let you go is about European banks. Raoul Pal, I don't know if you follow him on Twitter, he's put out a lot of good charts about the European banking index. Everyone knows about, who's paying attention knows about Deutsche Bank. The problems are extremely well documented about Deutsche Bank. Do you think that the European Central Bank, with all the crazy stuff that they're doing with negative interest rates and QE, that they have the European banking crisis under control, or do you think that this is just so big of a problem that the European Central Bank is not going to be able to plug all the holes?
I am on the side of people that believe that the negative interest rates is definitely negative for banks in general, for the business model of a bank. That makes absolutely no sense, and it hurts growth in general. And it's probably what we're seeing in the U.S. And it's sad when you see the president of in Germany, but it's sad when you see the president of the U.S. Asking for the same type of policy here in the U.S., meaning yields moving negative, and not thinking that's going to have an impact on growth, and not thinking that's going to have impact on the banking system. So that's the problem. Where the reason why I'm not so I guess following so much as other people on the European side is especially on the banking side, is because of the move they already have. I'm more interested in things that haven't moved yet as much, especially the Hong Kong banks, for instance, that look like the beginning of a kind of a falling knife kind of move in terms of a lot of the banks there, which we've seen. Probably Deutsche Bank had an enormous move on the downside, and it's obviously a problem, but at the same time, what if we do have, let's say, fiscal policy that helps those banks to move higher in a few months? I don't know. I think that's kind of already had a really large move, and I don't think there's as much juice on the trade as other places like Canadian banks and Australian banks, and I think those look really interesting still, especially given how they have those bloated banking systems, with housing prices really being here at the edge of a cliff, and I think that they're involved with the Chinese capital outflows. Those are exacerbating housing prices in Canada and in Australia for a long time. It's all linked. So I'm more interested in Canadian banks and Australian banks and those than anything else. Just the interesting thing about Canadian banks is look at what's happening with E&Ps in the U.S. and also in Canada. I mean, they're kind of like, depending on the way you look at it or depending on the company you look at, they're retesting global financial crisis levels. I mean, it's really that bad, and at the same time, Canadian banks are still, some of those Canadian banks, sure, a lot of them are start selling off already, but it's still really expensive in so many multiples you can look at. So I find those a little bit more interesting than the European markets in general. Besides, obviously, the understanding the side of the ECB and the BOE, I think those are major parts of understanding the macro environment, but the banking system is kind of more of a roadmap than anything else for me in terms of what could happen with other places, rather than becoming more proactive in that area and shorting a ton of European banks. We have not been doing that at all, actually. We've been focusing more on Asia and other places. There are derivatives of that trade.
Oh, I was just talking about systemically, because the European banks, the shares, like you said, have already crashed, so it's probably not really tradable. I was just asking if you think that it could systemically bring down the system, and that the European bank can't fix, European Central Bank can't fix things, and then maybe the Federal Reserve has to step in for systemic purposes, like what happened in what we know with the Ron Paul one-time partial audit, how the Federal Reserve gave out $16 trillion in interest-free loans. Ron Paul got a one-time partial audit from the Republicans and Democrats in 2011. If you think that might have to happen again.
Not so much on my radar, I guess, but I don't think. I think there will be more dilution of fiat currencies in general for other reasons, for more of weaker growth, and perhaps a lot of banks and European banks will prove to be failing businesses. But no, it's not. I have to say, it's not my expertise. I'm not really following that close specific banks if they're about to fail or not in Europe. I've been focusing most of my time in Asia, but no, I don't think I should speak for that as I'm not an expert on a topic. But
okay, that's fine. Yeah, I was actually researching this. I didn't know about this, but Canadian banks, everyone has been saying for a long time how Canadian banks came out of the 2008 financial crisis scot-free. There were no problems. But there was actually a Canadian regulator report in 2012, where their version of Freedom of Information Act, a research report released that Canadian banks actually got, I think, over $100 billion in TARP money from the U.S. So I was shocked. I found that out, I think, 6 months ago. I was shocked to learn that.
Yeah, that's interesting. Well, Canadian banks are in a very interesting position right now. I mean, oil is definitely a big part of the country. Energy is a large sector of the whole economy, and housing market is definitely, as toppy as it can look in terms of consumers being over leveraged historically, and also across countries too. When you look at versus other bubbles that we've had in the past, the household in Canada never been this leverage. I mean, it's a big problem, and at the same time, capital flows from China are drying up very quickly, and the Chinese currency has been devaluing. I mean, so the buying power of Chinese investors have been definitely going the other way, and I feel like that's where a lot of the opportunity is, especially when you look at those you do provisions for loan losses, research not just in Hong Kong, but if you look at Canada and Australia, they also look really low, and it's kind of interesting given the risk those places have in terms of a cycle that is probably about to turn lower. So I think that's for me, Canadian banks and Australian banks are a really large opportunity here in the short side. But
yeah, I agree. I think you're onto something. This is not financial advice, just my opinion. But the guy who shorted the Big Short, Steve Eastman, I think, he's been heavily short Canadian banks for I think about a year now. So that's his largest short position. And Australian banks are shocked to learn that they have enormous derivative positions related to the housing market. I did not know that they have tens of trillions of dollars in derivatives in addition. And I have a lot of listeners in Australia who listen to my podcast, and just them sharing their stories about housing markets and all the crazy things going on in Sydney, Melbourne, Brisbane, construction defects. I think there was a story that just came out in the last week or two about 2 million Australian dollars that uninhabitable tear-down properties are selling for in Sydney. That stuff is just boggling my mind.
Wow. Yeah. Australia looks really interesting as well. I mean, as far as you look at construction approvals or plunging, credit lending has been moving lower. I posted a chart yesterday of looking at credit for housing loans in general. It's been at the lowest year-over-year growth since in history, at least the history of the data, which goes back to the 1970s. That is all kind of confirming that that we're close to something here, especially in places like that. So it's really the valuation of the multiples of those banks in Australia as well look a lot like the banks in 2007 and 6 here in the U.S. So it's very seems clear to us that there is a problem. It's just the fact is when is it going to happen? You see the currency moving lower for a while now, right? I mean, the currency has been, I wouldn't say in a free fall, but it's been moving, 20, 15% lower in the last year or so. So it's definitely a big move. on the Australian dollar versus the dollar itself. So it's there's a lot of signs that there's some problems there. I haven't seen much of the yield curve inversion problem in Australia yet. I mean, it's 50% of the yield curve is inverted in Australia, not as high as other places. So I was expecting to see higher there, but that's let the data speak for you. In this case, it's definitely not on my side of the bearish case, and I have to respect that.
I want to thank you for your time today, Tavi. You've been more than generous with over an hour of your time. I know you're a busy guy, so you're doing a really good job with that. Congratulations on some of your winning trades, and keep putting out the great research work. You're very generous sharing a lot of that stuff on Twitter. I know a lot of people charge for things like that. So if my listeners want to follow you on Twitter and take a look at some of your research, how do they do so?
First of all, thank you so much for having me, and it was a pleasure talking to you and getting to know you as well. Great questions, by the way. It was a great discussion. My Twitter handle is @Tavi Costa, so @TAVICOSTA. Pretty easy to find me. I try to post charts pretty much every day on kind of the things that I follow and reinforce my views about the markets in general on a daily basis. And so hopefully your viewers will enjoy that.
Please like this video, share it with friends and family, and don't forget to subscribe to the Wall Street for Main Street YouTube channel if you have not already done so. Thanks for helping Wall Street for Main Street pass the 20,000 YouTube channel subscriber milestone despite YouTube censorship. Hopefully, we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down this channel. If YouTube does shut down this channel, remember to also sign up for the Wall Street for Main Street email list that's on the wallstreetformainstreet.com website and will tell you where the videos are going to be uploaded instead of YouTube. Also, if you really like the content and you decide that you want to give a one-time donation, you can go to wallstreetformainstreet.com, that's wallstreetformainst.com website, where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing my loyal listeners with some of the best information, analysis, and financial education available out there, free or paid, as I work to grow the podcast and also get my educational technology company funded.